Simply put, accelerating your mortgage means paying more than the required monthly payment. For example, if your scheduled monthly mortgage payment is $1,800, you pay an extra $200 per month and make a monthly payment of $2,000. Overpaying your mortgage moves up or accelerates the date when your mortgage is paid in full. Accelerating your mortgage can shorten the term of your mortgage by a number of years and save you tens of thousands or even hundreds of thousands of dollars in interest expense over the life of your mortgage. I'm going to briefly review the mechanics behind mortgage acceleration. Even though your scheduled mortgage payment does not change over the life of your mortgage, the split between principal, the part of your payment that pays down your mortgage balance, and interest, the part of your payment that pays the lender for borrowing the money, changes a little every month. When you accelerate or overpay your monthly mortgage payment, the dollar amount of your remaining scheduled monthly mortgage payments does not change, but the breakdown between the principal and interest components that make up your monthly mortgage payment does change. By overpaying your mortgage, you reduce your mortgage balance, and a lower mortgage balance results in a lower required interest payment. So although your monthly mortgage payment does not change, the interest component of your mortgage payment goes down, while the principal component of your mortgage payment goes up. You are paying down your mortgage balance faster or accelerating your mortgage, which reduces the total number of payments and interest expense. I'm going to walk through a couple of examples to demonstrate the financial benefits of mortgage acceleration. Let's take a look at a $380,000 30-year fixed-rate mortgage with a 4% interest rate and compare a mortgage where the borrower makes the required scheduled monthly payments to a mortgage where we apply mortgage acceleration. In both cases, the required monthly mortgage payment is $1,814. In the case where the borrower makes the required monthly payment, the borrower does not overpay his or her mortgage and makes 360 total monthly payments, or 12 payments a year for 30 years, and pays approximately $273,000 in interest expense over the life of the mortgage. Now, let's look at the accelerated mortgage and compare the two. In the case of the accelerated mortgage, let's say the borrower pays an extra $200 a month and makes a monthly payment of $2,014. By overpaying or accelerating his or her mortgage, the borrower reduces his or her mortgage term by more than 5 years, makes only 297 monthly payments instead of 360, and pays only $218,000 in interest expense over the life of the loan. So applying mortgage acceleration enables the borrower to make 63 fewer monthly payments and save approximately $55,000 in interest expense over the life of the mortgage. By paying an extra $200 per month over the life of the loan, the borrower overpays his or her mortgage by $59,400, but saves approximately $114,300 in total payments by reducing the length or term of the mortgage. It's important to point out that the more you overpay, the more money you save by accelerating your mortgage. Let's return to our example, but instead of overpaying the mortgage by $200 per month in the acceleration case, let's say the borrower overpays his or her mortgage by $300 per month and makes a mortgage payment of $2,114 per month. In this example, the borrower makes only 274 monthly payments instead of 360 and pays only approximately $199,000 in interest expense over the life of the loan. So applying mortgage acceleration enables the borrower to make 86 fewer monthly mortgage payments and save approximately $74,000 in interest expense over the life of the mortgage. Another important point to highlight about mortgage acceleration is that you can start accelerating your mortgage at any time. Even if you are several years into your mortgage, you can apply mortgage acceleration to reduce your remaining mortgage term and interest expense. Let's take a look at an example where the borrower is 10 years into an existing $380,000 30-year fixed-rate mortgage with a 4% interest rate. Let's say the borrower overpays his or her monthly mortgage by $200 per month at the start of year 11. In this example, the borrower makes only 325 monthly payments instead of 360 and pays only approximately $250,500 in interest expense over the life of the loan. So even though the borrower started applying mortgage acceleration 10 years into the mortgage, the borrower is able to make 35 fewer monthly mortgage payments and save approximately $22,500 in interest expense over the life of the mortgage. The examples we've reviewed have shown how mortgage acceleration can be applied to a fixed-rate mortgage, but you can also apply mortgage acceleration to an adjustable-rate mortgage or to an interest-only mortgage. In both cases, the borrower can apply mortgage acceleration to either lower the required monthly mortgage payment or control the mortgage payment in a rising interest rate environment. Regardless of what type of mortgage you have or how far you are into your loan, mortgage acceleration can be a valuable tool to reduce your mortgage term and save you tens of thousands or even hundreds of thousands of dollars in interest expense on your mortgage. We encourage you to check out our mortgage acceleration calculators as well as our detailed discussion and examples of mortgage acceleration in the mortgage acceleration section on freeandclear.com. Thank you for reviewing Mortgage Acceleration Overview with freeandclear.com. freeandclear.com.